Now you can see this inversion has been way worse. It's actually been as bad as the 1990s, when half of all banks and financial institutions that have ever gone bust in Canada actually went bust. And you've also got the Canadian dollar that is going down, which is not a good thing either, because that's going to put pressure on inflation. The Canadian dollar and the yield curve have something shocking to tell you, and we're going to get into it right now and discuss what has been going on here. Let's first of all start off with what triggered the sell-off in the Canadian dollar. So this is Chrystia Freeland, the Minister of Finance, and she said the Bank of Canada cut interest rates today. Canada was the first G7 country to cut rates last month. We are now the first G7 country to cut rates for the second time. She's almost standing there as a jester saying, "This is fantastic news, ladies and gentlemen. We're the first country to do this. We're the country with the weakest economy in the G7, essentially." That's not what she's saying, but she doesn't understand the implications of what's going on with the rate cut. And the rate cuts that are going on in Canada, not a good sign at all. And I was obviously joking when I had the video on the announcement the Bank of Canada did about the Bank of China, but the Bank of China literally came out the day after and cut rates. So very interesting what's happening there. Bank of China also cutting rates there. And we're going to look at the yield curve. The yield curve is incredibly important because of the predictive powers that it has. It predicted Canada was going into a depression long ago, and that is exactly what has happened. We've had the yield curve inverted for an unprecedented amount of time since 2022, and the yield curve inversion was massive, and we talked about it many times on this channel, but now it is beginning to uninvert by the front end of the curve, the 2-year yield coming down. So you can see what has happened with the spread variations over 1 week, 1 month, 6 months, and 1 year. And you can see that it is getting closer and closer together. And if you look at this on a chart here, you can see what's happened. The spread between the 10-year bond and the 2-year bond is narrowing and narrowing, and that is not a good sign. And we're also seeing this happen in the United States as well, which is indicative of a recession there as well. Usually when the yield curve uninverts, within 6 months, you're already in a recession. Now, we know that we're already in a recession right now in Canada. It's really the mass migration that is masking it, making the GDP numbers look better than they actually are. When you look at the GDP per capita story, that tells the story of what's really going on, which is a depression in Canada. That's no understatement to what is going on. People, whether they realize it or not, their standard of living is absolutely collapsing. That did not mean that you couldn't prepare for this years ago. Like I was saying, prepare. That is the best thing that you can do. It's so important to be prepared for things like that. And when you have 99.9% probability coming from the yield curve, you know what is going on. So if you look at the yield curve, this chart goes all the way back to 2016. And what's really interesting is you can see here when the yield curve actually inverted August 2019. And then you can see the inversion continued, and then it finally uninverted in around March of 2020, which was actually when Canada was in a recession. Now you can see this inversion has been way worse. It's actually been as bad as the 1990s, when half of all banks and financial institutions that have ever gone bust in Canada actually went bust. And you've also got the Canadian dollar that is going down, which is not a good thing either, because that's going to put pressure on inflation. You've got the Bank of Canada cutting key interest rate again, more cuts reasonable if inflation keeps easing. So they're saying that they're going to continue cutting now. The Bank of Canada cut its key interest rate to 4.5% on Wednesday, with Governor Tiff McClem saying during a news conference that it would be reasonable to expect further rate cuts if inflation continues to ease. I would ignore the latter part of that, if inflation continues to ease, because we're not stupid, guys. Look at an inflation chart. And actually, if you look at this CBC article, the cut was widely expected by economists after inflation eased in June. Okay, let's take a closer look at that. So if you look at what's happened since January, you've essentially got cumulative here this year, 1.9% of inflation. And we're obviously just halfway through the year right now, and we just had June statistics. So we've got half the year of statistics, and we're at 1.9% already cumulatively. Obviously, if you look at the year-over-year numbers, it looks like inflation is coming down, and that's great. But when you look at this, it looks like inflation pressures are actually piling up. And if you think they didn't even know about this June minus 0.1% when they were coming out with this, so essentially the central bank in Canada continues to cut interest rates. This is having a big impact on the currency, and the Forex market was largely anticipating the cut. These two vertical yellow lines are where the Bank of Canada's cut interest rates. This is the Canadian dollar versus the US dollar. I'm always looking at it the other way round, so forgive me if I get the numbers mixed up here because I'm always looking at US dollar, Canadian dollar. If you look at what's happened here, from the 11th of July, it has pretty much just gone straight down, anticipating this rate cut. I mean, it's an unbelievable losing streak, actually, because it's had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 out of 11 trading days down, and even the one day it was up, it was barely up that day either. The performance of the Canadian dollar is pretty abysmal. So you've got, it's down 1% in a week, it's down 1.19% in a month. Past 3 months, it's down 1.19%. 6 months, 2.51%. Year to date, 4.2%. And compared to 1 year ago, guys, the currency is down a whopping 4.71%. So think about how that is going to impact imports and the lag effect that that is going to have. Now, it's not my opinion that inflation is really going to start skyrocketing here unless the currency continues to slide. If we break 72 cents and then head down to 71 cents, you could see prices really starting to rise. It's not really a good thing for the Canadian dollar because, as I said on Wednesday on the rate announcement video, when you have a weakening currency, it's typically because your economy isn't doing very well. So that doesn't increase investment. Like the mainstream media and a lot of economists think that, oh, if your currency gets cheaper, then that's going to mean a lot of people are going to invest into your country and a lot of people are going to buy your goods because they become cheaper on the global markets. The fact is, that's really not the case of what happens at all. It's actually the complete reverse of that, and the currency is usually declined as a result of economic turbulence, which it certainly is in Canada. So you got major problems going on that the yield curve is signaling, and as this continues to uninvert, again, guys, it's just not a great sign of what's going on, but it's a sign of the times. Canadian banks weather US commercial market storm with limited exposure. Conservative lending shields from the worst of the market volatility. Canadian banks' restrained involvement in the US commercial real estate CRE market is offering a glimmer of reassurance to investors. Based on quarterly filings, CIBC has the most significant CRE exposure among its peers, allocating 11% of its loans to the sector. You got to remember as well, CIBC also has the most residential real estate exposure. So commercial and residential. Obviously, this doesn't account for all the off-balance sheet derivatives that are piling up and lots of banks are investing in. We don't know their exposure. We obviously know that the repo market is getting more and more illiquid, which is never a good sign because those are the big banks that are generally providing funding in there. And if they're not wanting to provide funding in the repo market, that is really a signal of bad things going on. And the Bank of Canada has had to do multiple injections of cash into the repo market. And again, that's never a good sign. That's almost always a sign of credit tightening, which is happening. And just to show you what's been going on with the Canadian banks, if you actually look at their stocks, and I've thrown Wells Fargo in here just to show you how they diverge, a US bank versus the Canadian banks. So since the rate cut, most of the Canadian banks actually declined on that news. Again, if you thought the real estate market was going to rip, and if you thought this was good for the banks, you're actually wrong because the market is interpreting it correctly so as that's actually bad for the banks because, again, why are they cutting rates? It's not because the economy is doing good, as Chrystia Freeland says. That's not the case at all. We know, obviously, when the government comes out and says something is good news for the economy, it's almost always the opposite is true. So with what's happening with the Canadian bank stocks, and look at how Wells Fargo essentially just completely diverges from all of them, the purple line there, but you can see that they are correlated to some extent there as well. So another thing that I want to note is obviously the unemployment rate is going up and has been going up consistently in Canada. That is never a good sign. Obviously, that's going to impact consumer spending, and it's probably going to have more of an impact on consumer spending than interest rates. And there's actually obviously a lag with that as well. And then you've also got job vacancies. And bear in mind, guys, these job vacancies here, they're not adjusted for population growth. So yeah, they're still higher than 2021. But if you think about how much the population has grown in Canada, it is absolutely terrible, the job vacancy growth that we've had right now. And it is showing the truth about the Canadian economy, which is it's imploding. If you look at hourly wages, they're up about 1.75% this year from the start of 2024. Meanwhile, if you look at the CPI, that's up around 1.9%. So it's keeping wages negative in real terms. And guys, you've got to remember, we're talking about the CPI here. We're not even talking about real inflation. We're talking about the CPI. So obviously, if wages are negative using the CPI, we know that wages are really, really negative. And again, that impacts purchasing power. That feeds into the economy. So negative real wages is never an actual good thing. It's not a sign of economic strength at all. It's a sign that, yet again, everybody in the economy, their purchasing power is going down and down and down, especially in provinces like Alberta, where you've had particularly high inflation, and you've had that on the East Coast as well, a lot of high inflation in those provinces. That means people's purchasing power is in decline even more there. So what we'll have to do over the next couple of weeks is continue to monitor what happens here on out with the Canadian dollar. Is it going to break some of these key levels? It already actually broke the key level from April of this year, which was the low of this year. Is it going to go down and break now the yearly low, which was from last year? We'll continue to monitor it and see what happens, but obviously it's not good. And it looks like the global economy is actually imploding. It's not just Canada. Canada is in a worse position. As Chrystia Freeland points out, the first country to cut rates in the G7. That's not a good sign. That's a sign that you're the weakest country in the G7. So I expect that the global economy is going to continue to implode, and unfortunately things are going to get a lot worse for people in the short term. So anyway, if you've enjoyed this video, I would highly recommend that you check out this video here. And if you're looking for a VPN to protect your privacy, use the affiliate link in the description and the pinned comment, expressvpn.com/marketmania. That's the VPN that I use, and I will see you in the next one. Take care.